Welcome back to the deep dive. Today, we're going deep into the world of International Financial Reporting Standards, or IFRS, as most people know them. You've sent over a pretty hefty document covering a whole bunch of IFRS and IAS standards, and it looks like you're ready to really get into the nitty-gritty of global finance.
Yeah, that's right. These standards are really important, especially in today's economy, because they create this common accounting language. And that lets us compare companies across different countries, sort of like having a universal translator for financial statements.
It's pretty amazing when you think about it, right? That businesses in, say, Japan and Brazil can be compared using the same set of standards. But let's get down to it. This document you shared covers so many different topics, like everything from revenue recognition to employee benefits, taxes, and even those really complex financial instruments. I mean, where do we even begin?
Well, it looks like the source material kind of emphasizes a few key standards, especially IFRS 15, which focuses on revenue from contracts with customers, and IAS 1, which is really the foundation for presenting financial statements. Those are definitely fundamental to understanding the core of IFRS.
Right, IFRS 15 and IAS 1.
Okay.
Okay, so let's start with IAS 1 then. That's the one that sets the stage for how companies put together their financial statements, right?
Exactly. It's all about presenting a clear and accurate picture of the company's financial health. Like imagine trying to understand how strong a company is financially. IAS 1 provides the guidelines for how that story is told through their financial statements.
So it's the framework for their financial narrative.
Precisely. And within IAS 1, there are 8 core things to consider, with fair presentation and the going concern principle being like the most important.
Going concern, so that basically means we expect the company to keep operating, right? Not about to go bankrupt.
Yeah, exactly. It's the assumption that the company will continue to operate for the foreseeable future. Yeah. It's like walking into a restaurant and assuming it's going to stay open long enough for you to finish your meal.
Okay, I like that. So let's talk about the statements themselves. IAS 1 talks about the statement of financial position, but a lot of people probably know this as the balance sheet.
Right, you got it. It's basically a snapshot of the company's financial position at a specific point in time, showing what they own, assets, what they owe, liabilities, and the owner's stake equity. And IAS 1 distinguishes between current and non-current for both assets and liabilities.
So current basically means short term, things that are expected to be used up or settled within a year, while non-current is for the long-term stuff.
Exactly. Think of it this way. The cash and credit cards in your wallet right now, those are your current assets. But your house or your retirement savings, those are your non-current assets.
Ah, I see. Okay. And then there's this thing called the operating cycle that IAS 1 talked about. What exactly does that mean?
The operating cycle is basically the time it takes for a company to convert its inventory into cash. It's kind of like the company's heartbeat. So they buy or produce goods, then they sell them, and then finally they collect the money.
Got it. So understanding that cycle helps you determine whether an asset or liability is short-term or long-term based on where it fits in that process of converting inventory to cash.
Exactly. Now, moving beyond the balance sheet, there's the statement of profit or loss, which most people call the income statement. But there's also the statement of other comprehensive income. And you might be wondering, why 2 different statements? Why not just one big one that shows all the income and expenses?
Yeah, why not just have everything together?
Well, the statement of profit or loss focuses on the company's core operations, their revenue, expenses, and the resulting profit or loss. It's basically their day-to-day business activity. But some gains and losses aren't included in this statement.
Oh, really? So it's not as simple as just adding up all the income and subtracting all the expenses?
Nope, not quite. That's where the statement of other comprehensive income comes in. It captures those items that aren't part of the company's main operations, but still affect their overall financial performance. Things like gains or losses on certain types of investments.
Ah, so it gives us a fuller picture of the company's financial performance beyond just their core business, kind of like looking at the whole ecosystem, not just one piece of it.
Exactly. And we can't forget the statement of changes in equity, which tracks the movements in the company's ownership structure. This includes share issuances, dividends, and changes in reserves. It tells the story of how the company's ownership is evolving over time.
Okay, so now that we've got a handle on those core financial statements, we can move into the more specific standards, right? And our document really highlights IFRS 13, which deals with fair value measurement. I've always been curious about this concept.
It's definitely an interesting one. Fair value is all about figuring out the exit price, meaning what a company would receive if they sold an asset or paid to get rid of a liability. And this is all assuming an orderly transaction between people who are knowledgeable and willing to buy or sell. It's a measurement based on the market, not specific to the company holding the asset or liability.
So it's kind of like figuring out what the market thinks an asset or liability is worth. It's not about what the company thinks, but what someone else would actually pay for it.
You got it. And to break it down even further, IFRS 13 introduces this three-level hierarchy of inputs to measure fair value. Level 1 is the most reliable and is based on observable prices in active markets, like stock prices, something like that.
Right, those are easy to find and very transparent. So what about level 2 and level 3 then?
Well, level 2 uses observable inputs, but they might not be as readily available. For instance, you might use comparable transactions to figure out the value of real estate. And then level 3, which is the least reliable, uses inputs that aren't observable, so you need to make more assumptions and use more judgment.
So it's kind of a spectrum of reliability, with level 1 being the most objective and level 3 the most subjective.
Exactly. And IFRS 13 doesn't say you have to use one specific valuation approach. There are three main ones: income, market, and cost. Each has its strengths and weaknesses, so the best approach really depends on what you're trying to value and the data you have available.
Okay, so there's no one-size-fits-all approach. Makes sense. Now, our document spends a lot of time on IFRS 15, which deals with revenue recognition. This seems like a pretty big deal, don't you think?
Oh, absolutely. Revenue is crucial for any business, and IFRS 15 provides this really solid framework for recognizing revenue. It makes sure companies are recording their revenue in a way that reflects the actual economics of their transactions.
So it's not as easy as saying, we got paid, time to recognize revenue. There's more to it than that, huh?
Yeah, there's definitely more to it. Under IFRS 15, revenue recognition hinges on the transfer of control, meaning when the customer actually gets control of the goods or services. This is a pretty big shift from older models of revenue recognition that focused on things like risks and rewards.
So it's not just about who possesses the asset, but who's actually calling the shots, who gets to decide what happens to it.
Exactly. And to help guide companies through this process, IFRS 15 outlines a five-step model. You start by identifying the contract with the customer, then you figure out the performance obligations, which are basically the promises to deliver specific goods or services.
Okay, so you break the contract down into its individual pieces, each promise.
Right, and then you determine the transaction price, or what the company expects to be paid. After that, you allocate that price to each performance obligation. And finally, revenue is recognized as each obligation is satisfied.
Okay, so it's a step-by-step process for recognizing revenue in a way that shows the actual delivery of value to the customer. Seems pretty straightforward, but I bet there are some situations that can be tough to figure out.
You're definitely right about that. There are a lot of nuances to IFRS 15, and that's where things can get a bit more complicated. For example, think about warranties. How do those work under IFRS 15? Should they be considered a separate performance obligation?
That's a good question. I mean, if I buy a phone with a warranty, am I essentially buying two things? The phone and the warranty service?
It really depends. Under IFRS 15, if a customer can buy a warranty separately, then it is treated as a distinct performance obligation. But if it's bundled with the product and they can't buy it separately, then it's handled differently, potentially under ISO 37, which we can get into later.
Okay, so customer choice is part of how you figure out how to deal with warranties. What other tricky situations are there?
Well, think about principal versus agent relationships. That distinction is really important for revenue recognition. Is the company the main provider of the good or service, or are they just helping with a transaction for someone else? That determines who recognizes the revenue.
Right, so a travel agent, for example, might just be an agent connecting travelers with airlines and hotels, so they wouldn't recognize the full price of the trip as revenue, just their commission.
Precisely. Then there are repurchase agreements, where a company sells an asset but agrees to buy it back later. IFRS 15 helps you figure out if these should be treated as leases or financing arrangements and how to recognize revenue for those situations.
So there's a lot to consider with repurchase agreements. What else?
Oh, and we can't forget about bill and hold arrangements. These are situations where the customer buys goods, but the seller keeps holding on to them, maybe because the customer doesn't have space to store them yet. IFRS 15 has specific criteria that have to be met for the seller to recognize revenue in these cases.
It sounds like IFRS 15 really covers a lot.
It does, but the goal is clear: to make sure revenue is recognized consistently and transparently in a way that reflects the true economics of the underlying transactions.
Okay, now let's switch gears and talk about assets. Our document really emphasizes IAS 36, which is all about impairment of assets. This standard helps figure out if an asset's value has dropped, right?
Exactly.
IAS 36 is all about comparing an asset's carrying amount, which is what's on the books, to its recoverable amount, which is what the company could realistically get for, either by selling it or using it. If the recoverable amount is lower, then we consider the asset impaired.
Okay, so let's say I bought a really fancy espresso machine for my cafe, but it turns out no one wants fancy coffee, just regular coffee. If I can only sell that espresso machine for a fraction of what I paid, I'd have to recognize an impairment loss, right?
That's a great example. IAS 36 helps companies assess those declines in value in a systematic way. And it applies to most assets, both tangible and intangible, as well as financial assets.
Okay, but how do you actually determine the recoverable amount? That's a good question. The recoverable amount is basically whichever is higher. Either the asset's fair value, less cost to sell, or its value in use, which is the present value of future cash flows the company expects from using the asset. It's all about figuring out what makes more sense financially.
So if I could potentially make more money by using my fancy espresso machine to keep making regular coffee instead of just selling the machine, its value in use would be higher, and I'd use that for the impairment test.
You got it. Now, let's say we do have an impaired asset. What happens next? Well, there's a specific order for allocating the impairment loss. First, you look at any assets that are damaged or specifically identified as impaired. Then any goodwill associated with that asset takes a hit. And finally, whatever impairment is left gets allocated to the other assets in what's called the cash-generating unit, usually proportionally.
Okay, so goodwill can be pretty vulnerable here, especially since it's often the hardest to value.
Absolutely. It's essentially the excess of the price paid for a business over the fair value of its identifiable net assets. It's often seen as intangible, tied to things like a company's reputation and synergy.
Okay, so goodwill is treated very cautiously under IAS 36. But what happens if the asset recovers some of its value after being impaired? Can you reverse that impairment loss?
Yes, you can, with some exceptions. IAS 36 lets you reverse impairment losses, except for goodwill. Goodwill impairment is permanent. But for other assets, if their recoverable amount goes up, you can increase the carrying amount accordingly. But you can only go up to the amount of the original impairment loss.
So there's some optimism built in, giving assets a chance to bounce back. But no second chances for goodwill, huh? Now let's move on to another key standard, IAS 16, which focuses on property, plant, and equipment, also known as PPE. We're talking about buildings, machinery, vehicles, the tangible things that companies use in their operations.
Exactly. IAS 16 provides guidance on everything from initially recognizing PPE to eventually disposing of it. It covers how to determine the cost, how to depreciate it over its useful life, and how to handle any subsequent revaluations or impairments.
Speaking of revaluations, IAS 16 offers two ways to measure PPE, the cost model and the revaluation model. What's the difference between those two?
Under the cost model, an asset is kept on the books at its historical cost, minus any accumulated depreciation and impairment losses. It's pretty straightforward, but it might not always reflect the asset's actual current market value. The revaluation model lets companies update the carrying amount to the fair value on the revaluation date.
So the revaluation model could give you a more up-to-date picture of the company's assets, but it also means doing valuations more often. It's kind of a trade-off between keeping it simple and making sure it's relevant.
Precisely. And importantly, with the revaluation model, you need to revalue the entire class of assets, not just pick and choose certain assets. Consistency is key.
Got it. Now, how did those revaluations actually affect the financial statements? Where did those gains and losses go?
That's where things get interesting. Generally, when revaluation increases happen, they are credited to other comprehensive income and added to what's called a revaluation surplus within equity. But if the asset had been impaired before, the revaluation increase would first reverse that loss in profit or loss, and then any extra would go to the revaluation surplus.
So you basically undo the previous impairment before boosting the revaluation surplus.
Exactly. And on the flip side, when a revaluation decreases, those are first recognized in profit or loss, but only to the extent that they reverse any previous revaluation surplus. Anything left over would then reduce the revaluation surplus. It's all about keeping those gains and losses in balance.
Okay, so it's about keeping things even. What about depreciation? How does that work with assets that have been revalued?
Well, depreciation is all about systematically spreading out the cost of an asset over its useful life. When an asset is revalued, its depreciation is recalculated based on the new carrying amount and any remaining useful life. This ensures that the depreciation expense actually reflects the asset's updated value.
So it's not just a one-time thing. The ongoing depreciation is affected too.
You got it. And when the asset is finally at the end of its useful life, or if it's sold, it gets removed from the statement of financial position. Any gain or loss on disposal, meaning the difference between what you get from selling it and its carrying amount, is recognized in profit or loss. That's basically the end of the road for that asset, at least on the company's books.
Makes sense. Okay, now let's talk about those assets that you can't actually see or touch, but that still hold value. Intangible assets. IAS 48 comes into play here, right?
That's right. We're talking about patents, trademarks, software, even goodwill. IAS 38 sets out the criteria for recognizing those intangible assets. They have to be identifiable, which means they can be separated from the business or come from contractual rights.
So they need to be distinct, not some vague notion of good vibes.
Exactly. And the company needs to have control over them, meaning they can benefit from the asset and stop others from benefiting from it. And lastly, there has to be a good chance that the asset will actually create future economic benefits for the company.
Makes sense. It can't just be wishful thinking, right? It needs to have real potential to contribute to the company's success. Now, one intangible asset that often sparks a lot of discussion is goodwill. Can companies just create goodwill internally and put it on their balance sheet?
That's a great question. And under IAS 38, the answer is a clear no. Internally generated goodwill can't be recognized on the balance sheet. It's thought to be too subjective and hard to measure accurately. Goodwill can only be recognized when it's acquired through a business combination, basically, buying another company.
So it's like you're paying a premium for the whole package of a company, including its reputation, brand, customer relationships, things you can't easily put a price tag on individually.
Exactly. Now, another area that can be tricky is research and development costs. IAS 38 draws a very clear line between research and development. Research expenses are expensed as they are incurred because there's no guarantee that they will result in future economic benefits. But development costs, on the other hand, can be capitalized under specific conditions. That means they can be treated as assets.
Okay, so there's a higher bar for development costs to be seen as assets. You need to be able to show that they're actually going to lead to something tangible and good for the company.
That's right. And even when development costs are capitalized, they still need to be amortized over their useful life, just like tangible assets. And of course, they are still subject to impairment testing.
Got it. So even though they're considered assets, they still need to be carefully evaluated. Now, what about other internally generated intangible assets, like a brand name, a list of customers, or publishing titles? Can those be capitalized?
Nope, another big no under IAS 38. Those types of assets are usually considered too hard to separate from the business itself and too hard to measure reliably. So any spending related to creating those things is usually expensed as it's incurred.
You can't just slap a value on your brand and call it an asset. It has to be acquired to be recognized on the balance sheet. Okay, so how are intangible assets measured after they've been initially recognized?
IAS 38 gives you two options: the cost model and the revaluation model. Sound familiar? The cost model, just like with PPE, means keeping the asset at its historical cost, less any accumulated amortization and impairment losses. The revaluation model allows an asset to be revalued to its fair value, but that's only possible if there's an active market for that specific type of asset.
Right, so you need to have readily available prices for similar assets. That's probably less common for intangible assets than it is for things like property, plant, and equipment. What about amortization? Is it basically the same as depreciation?
Yeah, amortization is the same idea as depreciation, but it's applied to intangible assets. It's the process of systematically allocating the cost of an asset over its useful life. But there's a key difference here. Intangible assets can have either a finite or indefinite useful life.
So something like a patent, which has a legal life of, say, 20 years, that would have a finite useful life and you would amortize it over that period. But a trademark that you expect to be valuable forever wouldn't be amortized at all.
Exactly. And even those intangible assets with an indefinite useful life, they still need to be tested for impairment at least annually.
Makes sense. So even if you're not amortizing it, you still need to check to make sure it's not losing value.
Right.
Now, I want to go back to business combinations for a minute. We talked about goodwill before. But how does that actually get accounted for when one company acquires another? IFRS 3 comes into play here, right?
You got it. IFRS 3 sets out the guidelines for dealing with business combinations. When one company acquires another, it has to recognize all the identifiable assets and liabilities of the acquired business at their fair values. And anything left over from the purchase price that's more than the fair value of those identifiable net assets, that's goodwill.
Okay, so it's like a premium you pay for the whole package, including things like synergies and potential, those intangible aspects that don't have a separate line item on the balance sheet.
Precisely. And IFRS 3 says that acquired goodwill has to be recognized as an asset. Initially is measured at cost, which is that difference we talked about between the purchase price and the fair value of the identifiable net assets. And importantly, goodwill isn't amortized. Instead, you test it for impairment at least once a year.
So, unlike other intangible assets, no amortization, just regular impairment checks.
Exactly. It's also worth mentioning that IFRS 3 covers those rare cases called bargain purchases. These are situations where the purchase price is actually lower than the fair value of the net assets you acquire. It's like finding a steal. And when that happens, you recognize a gain on the bargain purchase right away in profit or loss.
That's like finding a designer dress at a thrift store for a fraction of the original price. Lucky you. Now let's shift focus and talk about investment property. That's where IAS 40 comes in, right?
That's right. We're talking about property held to earn rental income or for capital appreciation, not property the company is actually using for its own operations. IAS 40 helps make a clear distinction between investment property, property that's owner-occupied, and inventory.
So even if a company owns a property, it's not automatically considered investment property. It depends on how they're using it.
Exactly. Like if a company has a big office building and they use some floors for their own offices, but rent out other floors, they have to account for those separately as long as those portions can be sold individually. It's about making sure you reflect the different ways the property is being used.
That makes sense. So how is investment property actually measured under IAS 40? Do you get to choose?
Yes. Similar to PPE, IAS 40 gives you two options, the cost model and the fair value model. The cost model, as we've talked about, means keeping the asset at its historical cost, less accumulated depreciation, and any impairment losses. The fair value model, on the other hand, requires you to revalue the investment property to its fair value at each reporting date.
Okay, so under the fair value model, the carrying amount of the investment property is constantly being updated to show market fluctuations. That seems like it could make the financial statements more volatile.
It can, but it also provides a more up-to-date picture of the investment property's actual value. It's a trade-off that each company needs to think about.
Okay, it's similar to PPE then. Do you want to keep it simple or make sure it's relevant? Now, let's move on to IFRS 5, which deals with non-current assets held for sale and discontinued operations. This one seems to be all about assets on their way out.
That's a good way to put it. IFRS 5 gives specific guidelines on how to account for assets that are either classified as held for sale or are part of what are called discontinued operations. The goal is to be more transparent for anyone looking at the financial statements, helping them tell the difference between parts of the business that are continuing and those that are being wrapped up.
Okay, so if a company decides to sell off a whole division or shut down a particular product line, IFRS 5 would apply.
Exactly. So let's look at how an asset gets classified as held for sale. First, the asset has to be ready for immediate sale in its current condition. No major repairs or upgrades needed. Second, the sale has to be highly probable, meaning management is committed to the sale, they're actively looking for a buyer, the asset is being marketed at a reasonable price, and they expect to complete the sale within a year.
So it can't just be a vague intention. There has to be real evidence that the sale is imminent. What happens to the asset once it's classified as held for sale?
Once those criteria are met, the asset is measured at the lower of its carrying amount, and fair value less costs to sell. It's a cautious approach, making sure the asset isn't overstated on the balance sheet.
And I assume depreciation also stops at that point, right?
You're exactly right. No need to keep depreciating something that's about to be sold. IFRS 5 also addresses discontinued operations. These are components of a business that has either been disposed of or are classified as held for sale, and they represent a major line of business or a geographical area of operations.
So it's a pretty big chunk of the business that's being carved out.
Exactly. IFRS 5 says that the results of those discontinued operations need to be presented separately in the statement of profit or loss. That segregation helps anyone looking at the statements understand the financial impact of those operations and make more informed projections about the company's future performance.
It's like drawing a line in the sand between the past and the present, so investors can focus on what's driving the company's current operations. Does IFRS 5 require any specific disclosures about those assets and operations?
Oh, absolutely. IFRS 5 is very clear that you need to disclose certain information, including a description of the assets, the circumstances surrounding the disposal, and any gains or losses that were recognized. It's all about transparency and giving users the information they need to understand what's going on.
Okay, a lot of important details in IFRS 5. Now let's move on to those often welcome injections of cash government grants. IAS 20 tells us how companies should account for these, right?
You got it. Government grants can be really helpful, especially for companies in certain industries or specific regions. IAS 20 ensures those grants are accounted for correctly, recognizing the income they represent, but also considering any conditions attached to them.
So it's not exactly free money. Often there are strings attached, right?
Exactly. IAS 20 distinguishes between government grants and other kinds of government assistance. A grant is basically a transfer of resources, usually cash, that's given in return for past or future compliance with specific conditions. Other forms of assistance, like tax breaks or subsidized loans, are treated differently.
So a grant is like a reward for hitting specific goals, while other types of assistance are more like incentives or perks.
That's a good way to think about it. Now, when it comes to actually accounting for those government grants, IAS 20 offers two main approaches. The grant can be recognized as deferred income, meaning the income is spread out over the periods when the related expenses happen, or it can be deducted from the carrying amount of the asset it relates to, essentially reducing the cost of the asset.
So you can choose between recognizing the income and gradually or reducing the expense up front.
Precisely.
Yeah.
And which way you go depends on the type of grant and the expenses that go with it. And of course, if you have to repay the grant, IAS 20 tells you how to handle that too.
Okay, so IAS 20 covers everything about a government grant, from start to finish. Now let's switch gears to a totally different industry, agriculture. Our document talks about IAS 41, which helps us understand how to account for all the unique assets and products you find in agriculture.
Right. We're talking about things like animals and plants, living things that IAS 41 calls biological assets. This standard recognizes that these assets are constantly changing. They grow, they reproduce, and eventually they yield agricultural produce.
Right. Unlike most other assets, biological assets are literally growing in value.
You got it. That's why IAS 41 says that biological assets have to be measured at fair value, less cost to sell at each reporting date. That means the carrying amount is always being adjusted to reflect their current market value, and any gains or losses from those changes in fair value are recognized in profit or loss.
Okay, so there's a big focus on fair value with biological assets.
Definitely. It's the best way to show their dynamic nature. And once that agricultural produce is harvested, it's treated as inventory under IAS 2, measured at the lower of cost and net realizable value.
So IAS 41 takes us all the way from the farm to the market, from those living assets to the products that are harvested. Now, our document mentions government grants specifically for agricultural activities. Do those work differently under IAS 41?
That's a good point. Government grants for agriculture are treated similarly to other government grants, but there's one thing to remember. If you are measuring the biological asset at fair value, less cost to sell, you don't apply IAS 20.
So the fair value model takes priority in that case.
Exactly. Now, we can't forget about IAS 2, which deals with inventories. We're talking about raw materials, work in progress, and finished goods, the core of so many businesses.
Right. IAS 2 helps companies keep track of their inventories and make sure they're not overstating their value on the balance sheet. What are some of the most important things to remember with inventory accounting?
One of the most important aspects is choosing the cost flow assumption. Companies have to choose a method for figuring out the cost of goods sold. Some of the common methods are first in, first out, FIFO, weighted average, and last in, first out, AISOF. And each of these has different implications for the cost of goods sold and the ending inventory. The key is to pick a method that makes sense for your business and then stick with it.
Okay, so pick a method and be consistent. What else is important?
Well, there's the lower of cost and net realizable value rule, which is a cautious principle that makes sure inventories aren't carried on the books at a value higher than what the company could realistically get from selling them.
So if the market value of an inventory item drops below what it cost, the company needs to recognize a loss, even if they haven't sold the item yet.
Exactly. IAS 2 helps companies deal with all those ups and downs in inventory value and make sure their financial statements show a true picture of their stock.
Okay, so now let's talk about borrowing costs. IAS 93 provides guidance on when companies are allowed to capitalize those.
Right, borrowing costs are basically the interest and other expenses that come with borrowing money. IAS 23 tells you when you can capitalize these costs, which means adding them to the cost of an asset rather than just expensing them right away.
So it's kind of like matching the cost of financing with the asset you're buying or building with that financing. So if I take out a loan to buy a delivery truck for my business, I can capitalize those borrowing costs.
You got it. But it's not just about having a loan. IAS 23 says there are conditions that need to be met. The company has to be actively spending money on the asset. They have to be incurring those borrowing costs, and they have to be actively getting the asset ready for its intended use.
So there needs to be actual progress on the asset, not just a loan sitting around. And once capitalization starts, it continues until the asset is basically finished and ready to use.
Precisely. Now let's move into a more specialized area, the exploration and evaluation of mineral resources. This is where IFRS 6 comes in.
This sounds pretty niche. Tell me more about it.
It is. IFRS 6 applies to companies that are exploring and evaluating mineral resources, like oil, gas, and minerals. It gives guidance on how to account for those costs incurred before you actually know if those resources can be extracted economically.
So it's about those early stages when you don't know if you've struck gold, figuratively speaking.
Exactly. IFRS 6 says that companies can choose between the cost model or the revaluation model for measuring exploration and evaluation assets. We've talked about these models before. The cost model is easier, but might not reflect changes in value, while the revaluation model is more complex, but potentially more relevant. Just like with other assets, those exploration and evaluation assets have to be checked for impairment.
So the same principles apply even in a more specific industry. Now, our document also goes into the world of liabilities, particularly IAS 37, which focuses on provisions, contingent liabilities, and contingent assets. This feels like a complicated area.
It can be. But IAS 37 helps you navigate all those unknowns that often come with liabilities. It gives you a framework for recognizing and measuring provisions, which are liabilities that have some uncertainty about timing or amount, and it also covers disclosing contingent liabilities and contingent assets, which are potential obligations and assets that depend on something happening in the future.
So it's about dealing with those what-if scenarios where you don't really know for sure if an obligation exists or how much it might end up being.
Exactly. To be able to recognize a provision, three things have to be true. First, there needs to be a present obligation, either legally or in practice, and that obligation has to come from a past event. Second, it has to be probable that you'll need to use resources to settle that obligation. And third, you need to be able to reliably estimate the amount of the obligation.
Okay, so if I spill my coffee on someone's laptop and they get mad and say they'll sue me, that's a contingent liability, right? Because it's a potential obligation. But it depends on if they actually file a lawsuit and if I'm found responsible.
Exactly. Until you know for sure about those things, you wouldn't recognize a provision. But if I had a contract that said I had to dismantle an oil rig after its useful life, that would meet all the criteria for a provision. There's a present obligation. It's very likely I'll have to pay to dismantle it, and I can make a pretty good estimate of how much that will cost.
So there's a clear difference between provisions and contingent liabilities. Now, what about contingent assets?
Contingent assets are kind of the opposite of contingent liabilities. They're potential assets, but whether you actually get them depends on something happening in the future. You don't recognize them in the financial statements until it's practically certain that you'll receive them. Until then, you just disclose them in the notes.
So it's kind of like winning the lottery. You hope you'll win, but there's a chance you won't. So you don't count on it until you actually have the winning ticket. What are some common types of provisions that companies often deal with?
Common ones include things like provisions for warranties, restructuring costs, environmental cleanup, and decommissioning of big assets. Each of these has its own quirks, but the main principle is the same. You only recognize the liability when it meets those three criteria we talked about earlier.
Okay, let's take warranties as an example. How are those provisions figured out?
For warranties, companies need to estimate how much it's going to cost them to honor those warranties in the future. They take into account things like historical failure rates of similar products, the terms of the warranty, and how much they expect repairs or replacements to cost. It's all about forecasting, using past data and current trends to project future costs.
So it's like being a fortune teller, but instead of a crystal ball, you're using spreadsheets and historical data.
Yeah, that's a fun way to put it. Now, restructuring provisions can be a little more complicated. These usually come into play when a company is making big changes to its operations, like closing factories or laying off employees.
Right, those are big decisions with significant financial implications. So how does IAS 37 help companies account for those restructuring activities?
Well, IES 37 specifically addresses when those restructuring provisions can be recognized. You need to have a detailed plan in place. It has to be very likely that the restructuring is going to happen, and the costs need to be directly tied to the restructuring.
So no vague ideas or what-if scenarios, it needs to be concrete.
Exactly. And it's really important to be able to tell the difference between restructuring costs and just normal business expenses. You shouldn't include things like marketing or retraining in restructuring provisions because those are part of the day-to-day running of the business.
Right, it's about separating those one-time costs from the regular costs of doing business. What about provisions for environmental remediation?
Those might come up when a company has contaminated some land or water and is legally required to clean it up. IS 37 says you have to recognize a provision for those cleanup costs, and you base that provision on the best estimate of the effort and resources required to clean up the mess.
So it's about taking responsibility for any environmental damage and showing that responsibility in the financial statements.
Exactly. And lastly, there are decommissioning provisions. You see these a lot in industries like oil and gas or nuclear power, where companies have these huge assets like oil rigs or power plants that eventually need to be taken apart and removed.
That sounds like a huge job.
It definitely is.
Yeah.
IAS 37 requires those companies to recognize a provision for the future costs of decommissioning, even if it won't happen for decades. That provision is often calculated using something called discounted cash flow techniques to account for the fact that money today is worth more than money in the future.
So it's like factoring in the future cleanup costs right from the beginning. Okay, let's move on to the people who make all these businesses work, the employees. IAS 19 deals with a whole range of employee benefits, everything from salaries and wages to pensions and healthcare.
Absolutely. IAS 19 covers it all. Any kind of compensation given by an entity to its employees in exchange for their services. It identifies four main categories of employee benefits: short-term benefits, post-employment benefits, other long-term benefits, and termination benefits. And each of those has its own accounting treatment depending on the timing and nature of the benefit.
Okay, so it's not just about salary. There are all kinds of employee benefits out there, each with its own accounting implications. Let's start with short-term benefits. What exactly falls under that category?
Short-term benefits are those we expect to settle within 12 months after the end of the reporting period when the employee did the work. So that includes salaries, wages, paid time off, short-term bonuses, and even non-monetary benefits like health insurance premium.
Okay, so those are the more immediate things employees get. How are those accounted for under IAS 19?
IAS 19 says you recognize those short-term benefits as an expense in the period when the employee actually does the work. It's the matching principle. You recognize the cost when the benefit is earned.
Makes sense. So post-employment benefits are those that come after someone retires, right? Things like pensions.
You got it. These are usually long-term and often involve actuarial assumptions to figure out their present value. Pensions are the most common example, but it can also include things like retiree health care and life insurance.
Right, there's a lot of forecasting involved because you're trying to predict costs that won't happen for years, maybe even decades.
That's right. And IAS 19 differentiates between defined contribution plans and defined benefit plans. In a defined contribution plan, the employer puts a fixed amount into a separate fund, and the employee's retirement benefit depends on how well that fund does. The accounting for this is fairly simple. The employer just recognizes an expense for the money they contribute.
Okay, so it's like putting money aside every year and letting the market do its thing.
Huh.
What about defined benefit plans? Those sound a bit more complex.
They definitely are. In a defined benefit plan, the employer promises a specific retirement benefit, and that's where things get tricky. IAS 19 requires the employer to recognize a liability for the present value of all those future benefits. To figure out the present value, you need to make actuarial assumptions about things like how long employees will live, how much their salaries will go up, and the discount rates.
Wow, so there's a lot more uncertainty and estimation involved because you're dealing with a much longer period of time.
Exactly. And as those actuarial assumptions change, the liability can move up or down, which leads to gains or losses that need to be recognized in the financial statements.
So defined benefit plans definitely add another layer of complexity. What about those other long-term benefits that aren't post-employment benefits?
Those are benefits that last longer than 12 months but aren't tied to retirement. Things like long-term disability insurance, sabbatical leave, or deferred compensation plans.
So benefits that fall somewhere in between those short-term benefits and the post-employment ones.
Exactly. Accounting for those other long-term benefits is similar to defined benefit plans. You estimate the present value of the future benefits and recognize a liability. However, IAS 19 simplifies things a little by saying you don't have to recognize remeasurements in other comprehensive income. Instead, the net effect of the service cost, interest, and remeasurements all goes into profit or loss.
So it's a little less complicated than defined benefit plans. Okay, what about termination benefits?
Termination benefits are those given to employees when their employment ends, like severance packages or early retirement incentives. IAS 19 says you recognize these benefits as an expense and a liability when it's clear that the company is definitely going to provide them.
So you recognize the liability when it's basically inevitable.
Exactly. And how you measure those benefits depends on when they're expected to be settled. Short-term settlements are treated like short-term benefits, while long-term settlements are treated like other long-term benefits.
Okay, so IAS 19 really does cover all the bases when it comes to employee benefits. Now, our document takes us to a topic that's caused a bit of a stir in the accounting world, leases. IFRS 16 brought about some big changes to lease accounting, making lessees recognize most leases on their balance sheets.
Yeah, IFRS 16 was a game changer. Leases are everywhere in the business world, and IFRS 16 wants to make sure they're represented more faithfully. Before, a lot of companies could keep leases off their balance sheets, which could distort their financial position. IFRS 16 shines a light on those hidden liabilities.
So it's all about transparency, but are there any exceptions to this whole on-balance sheet thing?
There are a couple. Short-term leases and leases of low-value assets don't have to be recognized on the balance sheet. Short-term leases are those with a term of 12 months or less, while low-value assets are things that aren't super dependent on other assets and that the lessee can benefit from on their own, things like office furniture, computers, small tools.
So if a company rents a copier for a year or leases a few laptops for their employees, they don't have to put those on the balance sheet.
That's right. But for all the other leases, IFRS 16 says the lessee has to recognize a right-of-use asset and a lease liability. The right-of-use asset represents the lessee's right to use the asset for the lease term, while the lease liability represents the obligation to make those lease payments.
Okay, so it's like splitting the lease into two parts, the right to use it and the obligation to pay for that right.
You got it. The right-of-use asset is initially measured at cost, which includes the initial amount of the lease liability, any lease payments made at or before the lease starts, minus any incentives received, and any upfront costs directly related to the lease. It's then depreciated over either the lease term or the useful life of the asset, whichever is shorter.
Okay, so it's basically treated like any other asset, recognized at cost and then depreciated over time. How is the lease liability dealt with?
The lease liability starts out being measured at the present value of all the future lease payments, discounted using the interest rate that's built into the lease. As you make lease payments, the liability goes down, and it goes up as interest is added to the outstanding amount. It works pretty much like a loan.
Right, you've got the principal and the interest. And IFRS 16 ensures that this liability is clearly shown either on the balance sheet itself or in the notes.
Exactly. IFRS 16 also gives guidance on those sale and leaseback transactions where you sell an asset and then lease it right back from the buyer. Those could be tricky, and IFRS 16 helps determine whether to treat them as actual sales or just financing arrangements.
So it stops companies from using those kinds of transactions to try to manipulate their financial position. Does IFRS 16 also deal with the accounting for the lessor, the one who owns the asset and is leasing it out?
It does. IFRS 16 makes a distinction between finance leases and operating leases for lessors, and each has its own accounting treatment. It makes sure things are consistent and transparent on both sides of the lease.
Okay, that makes sense. Now let's get into an area that's super important, but maybe not the most exciting: taxes. IAS 12 provides the framework for how to account for income taxes.
Right. Income taxes, we all have to deal with those. IAS 12 helps companies navigate this complex world. It makes sure that their financial statements properly reflect the impact of taxes on their transactions. It's all about connecting accounting profit with taxable profit.
And I can see how those could be different. So IAS 12 helps us reconcile those differences and make sure that taxes are accurately reflected.
That's exactly it. Accounting profit is the profit that a company reports in its financial statements, but taxable profit is the profit that's actually subject to tax under the law. And these two often end up being different because of timing differences and permanent differences.
Okay, walk me through those differences. What are they exactly?
Timing differences are when revenue or expenses are recognized in different periods for accounting and tax purposes. Depreciation is a good example. It can be calculated differently for accounting and for tax purposes. Permanent differences, on the other hand, are when some items are included in one but not the other, like tax-exempt income or expenses that you can't deduct for tax purposes.
So IAS 12 helps manage all those little discrepancies between accounting profit and taxable profit, both temporary and permanent ones.
Exactly. Now, within IAS 12, we also need to understand the difference between current tax and deferred tax. Current tax is pretty straightforward. It's the income tax that you either have to pay or that you're getting back for the current period, based on the taxable profit for that period.
So that's the tax bill for the year. What about deferred tax?
Deferred tax is a little bit more complex. It comes from those timing differences we were talking about. When there's a temporary difference between the carrying amount of an asset or liability in the financial statements and its tax base, that's the amount attributed to it for tax purposes, you can end up with deferred tax assets and liabilities.
Okay, so it's like taking into account the future tax consequences of those timing differences.
Exactly. You get a deferred tax liability when the carrying amount of an asset is higher than its tax base, or when the carrying amount of a liability is lower than its tax base. That means you'll have to pay more tax in the future.
So like a future tax bill waiting to happen?
Exactly. And a deferred tax asset is the opposite. It happens when the carrying amount of an asset is lower than its tax base, or when the carrying amount of a liability is higher than its tax base.
Oh.
That means you'll pay less tax down the road.
Like a tax credit or deduction waiting for you in the future.
Precisely. IAS 12 gives clear guidance on how to recognize and measure those deferred tax assets and liabilities using the applicable tax rates and how to show them in the financial statements.
Okay, so IAS 12 really does cover all the bases when it comes to taxes. Now let's move on to financial instruments. These are contracts that create financial assets for one entity and financial liabilities or equity instruments for another. Our document mentions 3 key standards for this: ISS 32, IFRS 7, and IFRS 9.
Financial instruments, that's a huge area covering everything from cash and receivables to complex derivatives.
Yeah, it seems like a lot to cover. Let's start with some common examples. What are some of the financial instruments that we might be familiar with?
Think of things like cash, money people owe you, receivables, money you owe to others, payables, bonds, loans, investments in other companies' stock, equity investments, and of course there are derivatives.
Yeah, derivatives. Those are the ones that can get really complicated, right?
They can. They're basically contracts where the value is based on something else, like the price of a stock, a commodity, or an interest rate. You can use them for hedging, which is managing risk, or for speculation, which is trying to make money by betting on how prices will change in the future.
So they can be a double-edged sword. They can reduce your risk or increase it, depending on how you use them. So how do those standards help us figure out the accounting for these instruments?
Well, IAS 32 is focused on the presentation of financial instruments. It makes sure they're classified and presented correctly in the financial statements. It helps you tell the difference between liabilities and equity and addresses those instruments that have characteristics of both.
So it's all about putting everything in the right category and preventing companies from trying to make their financial position look better than it really is.
Exactly. And a key principle in IAS 32 is substance over form, meaning you should look at the economic reality of a financial instrument, not just its legal form.
So even if something is legally considered equity, if it acts more like debt, it should be treated as debt. It's about looking beyond the legal language and understanding how it actually works.
You got it. And there's IFRS 7, which deals with the disclosures you have to make about financial instruments. It requires companies to be open about their exposure to different risks, like credit risk, liquidity risk, and market risk.
So it's about making sure investors have a clear understanding of the potential risks that come with these instruments, no hiding anything.
Exactly. And then there's IFRS 9, the most comprehensive of the 3. This standard covers recognizing, measuring, impairing, and doing hedge accounting for financial instruments. It replaced ILS 39, which had gotten pretty complicated. IFRS 9 brings a few key changes, including a more principles-based approach to classifying and measuring financial assets, a new expected credit loss model for impairment, and a more flexible way to handle hedge accounting.
It sounds like IFRS 9 is a pretty big overhaul.
It definitely is. One of the big changes is how financial assets are classified. IFRS 9 moves away from a strict set of rules and towards a more principles-based approach, focusing on how the company actually manages those assets and how they generate cash flows.
So it's more about understanding the purpose and how those assets work.
Precisely. IFRS 9 groups financial assets into three main measurement categories: amortized cost, fair value through other comprehensive income, which is sometimes called FVTOCI, and fair value through profit or loss, which is also known as FVTPL.
Okay, three buckets for financial assets. How do you tell the difference between them?
Amortized cost is for those assets that are held to collect money, and those payments represent just the principal and interest. Think of a basic loan or a bond. FVTOCI is kind of a mix. It's for assets held both to collect those payments of principal and interest A&D for sale. And FVTPL is for everything else, including those held for trading.
So FVTPL is for the more complicated or actively traded assets.
You got it. Another big change in IFRS 9 is the impairment model. It introduces this thing called an expected credit loss, ECL model. What that means is that companies need to recognize potential credit losses on financial assets as soon as those losses are likely to happen, rather than waiting for proof that they've actually been impaired. It's a more forward-looking approach, anticipating losses instead of just reacting to them.
That makes sense, especially considering how uncertain the economy can be.
It does. IFRS 9 also changes how you do hedge counting, making it more flexible and more in line with how companies actually manage risk. They have more choices when it comes to choosing their hedging instruments and the risks they're trying to manage.
So IFRS 9 is a pretty big deal in the world of financial reporting. It updates how we account for financial instruments, bringing more transparency and accuracy to the process. Now, our document also highlights segment reporting, which is especially important for publicly traded companies. IFRS 8 sets out the framework for this, right?
That's right, IFRS 8. It's all about making things clearer by requiring companies to give information about their different operating segments. These are the parts of the business that actually generate revenue and incur expenses.
So instead of just seeing the big picture of the company's overall results, you can look under the hood and see how each part is doing.
Exactly. It helps anyone looking at the financial statements understand the risks and opportunities associated with each part of the business and how they contribute to the company's overall performance. But you don't have to report on every single operating segment. IFRS 8 says a segment has to meet certain thresholds to qualify as a reportable segment.
Okay, so if a segment is really small or insignificant, you might not have to report it separately.
Exactly. But if a segment does meet those thresholds, IFRS 8 requires a lot of disclosures, including things like revenue, expenses, profit or loss, assets, liabilities, and certain specific income and expense items. This gives people looking at the statements the information they need to assess how well the segment is doing and how much it contributes to the company as a whole.
So a lot of detailed information for those important segments. What about geographical information? Does IFRS 8 deal with that too?
It does. IFRS 8 requires companies to give information about where they operate around the world, including revenue and long-lived assets. This helps users understand the company's global footprint and their exposure to risks in different economic and political environments.
It's like a map of the company's worldwide operations. Now, our document also brings up another key financial metric that investors pay a lot of attention to: earnings per share, or EPS. IAS 33 provides the guidance here.
Earnings per share, or EPS, it's a really important measure of a company's profitability. It tells you how much profit the company made for each share of common stock they have outstanding.
So a higher EPS usually means the company is more profitable.
Generally, yes. But you always have to look at other things too, like what industry the company is in, their growth potential, and their financial risk. EPS is a good starting point for comparing companies, but it's not the whole story.
Right, it's just one piece of the puzzle. What are the key things in IAS 33 that we should keep in mind?
Well, IAS 33 makes a distinction between basic EPS and diluted EPS. Basic EPS is calculated by dividing net income that's attributable to common shareholders by the weighted average number of common shares that were outstanding during the period.
Okay, so it's basically profit divided by the number of shares. Pretty straightforward. So what's different about diluted EPS?
Diluted EPS takes into account the potential dilution that could happen if certain securities like convertible bonds or stock options were actually exercised. Those could increase the number of shares outstanding, which would then reduce the earnings per share.
So diluted EPS is like a worst-case scenario reflecting what could happen if those things actually took place.
Exactly. IAS 33 goes into a lot of detail about how to calculate both basic and diluted EPS, covering things like stock dividends, stock splits, and shares that might be issued depending on certain things happening.
So there are a lot of rules to follow when it comes to EPS. But the idea is to make sure everyone's calculating and reporting this important metric in a consistent and transparent way. Now, our document shifts to foreign currency transactions, something that's super relevant for multinational companies. IAS 21 helps navigate the complexities of dealing with different currencies.
You're right. In today's global economy, many companies have transactions in lots of different currencies. IAS 21 provides a framework for accounting for those transactions and for translating foreign currency financial statements.
But with so many currencies fluctuating all the time, it seems like things could get really messy.
They definitely can. That's why IAS 21 introduces these concepts called functional currency and presentation currency. The functional currency is the currency of the main economic environment where an entity operates. It's the currency that has the most influence on the entity's sales prices, their labor costs, and their financing. The presentation currency, on the other hand, is the currency that you use to present the financial statements.
So a company based in the US, but with a subsidiary in Germany, for example, might have the euro as the subsidiary's functional currency, but the consolidated financial statements are presented in US dollars.
Exactly. And IAS 21 says that foreign currency transactions have to be initially recorded in the functional currency using the exchange rate at the time of the transaction. Then, monetary items, meaning assets and liabilities that are fixed or can be determined in terms of money, are retranslated at each balance sheet date using the closing exchange rate.
Okay, so those monetary assets and liabilities get updated to reflect the current exchange rates. What about non-monetary items?
Non-monetary items like property, plant, and equipment are usually translated using the exchange rates from when they were acquired, unless they are carried at fair value, in which case you use the exchange rates from when those fair values were determined.
So different rules for different types of items.
Yep. And when you're translating complete sets of financial statements from a foreign currency, IAS 21 says you need to use either the current rate method or the temporal method, depending on the functional currency of the foreign operation. It can get a little complicated, especially when you're dealing with situations where there's hyperinflation, but the goal is always to accurately reflect the effects of those changes in foreign currency rates.
Okay, so there's a lot to consider with those foreign currency transactions. Now, our document brings up another common form of compensation, especially these days, share-based payments. IFRS 2 guides us through the accounting for these, right?
Share-based payments are transactions where a company gives equity instruments, things like shares of stock or stock options, to employees or other people in exchange for goods or services. It's a way to attract and keep good employees, align everyone's incentives with the interests of the shareholders, and it can also help conserve cash.
So it's like paying people with a piece of the company itself, not just with money.
Precisely. IFRS 2 says you need to recognize the cost of those share-based payments over the period when the goods or services are actually received.
Okay, so it's not just a one-time expense when the shares or options are given out. You spread the cost out over time.
Exactly. IFRS 2 differentiates between equity-settled, share-based payments, where the company directly gives out the shares, and cash-settled ones, where they promise to pay cash based on the value of those equity instruments.
So you either get a piece of the company or you get a promise to be paid based on how much the company is worth.
That's a good way to put it. Measuring the cost of share-based payments, especially equity-settled ones, can be a little tricky. IFRS 2 tells you how to determine the fair value of the shares or options that are given out and how to recognize that cost over the vesting period, which is basically the time the employee has to work to actually earn the right to those instruments.
So it's all about figuring out what those shares are worth and then spreading the cost out over the time it takes for the employee to actually own them. Does IFRS 2 deal with anything else about these share-based payments?
Yeah, it covers things like what to do if those agreements are modified or canceled, or if those shares are reissued, making sure those events are accounted for correctly. IFRS 2 is basically a complete guide for managing these types of compensation, which are becoming more and more common.
Okay, so from the moment you grant them to the moment they're settled, IFRS 2 has got you covered. Now, our document shifts focus to companies that are using international financial reporting standards for the very first time. IFRS 1 provides the instructions for making that transition.
IFRS 1, the welcome guide to the IFRS world. Changing over to IFRS can be a big project, and IFRS 1 helps companies get ready to prepare that first IFRS statement of financial position, handle accounting policy changes, and make the required disclosures.
So it's about making that switch as smooth as possible. What are some of the things you have to think about when switching to IFRS?
Well, IFRS 1 says you need to prepare an opening IFRS statement of financial position on the date you make the transition. That means restating your previous financial statements so they comply with IFRS, and any adjustments you make go directly to equity.
So you're basically rewriting history to make sure everything aligns with IFRS.
Exactly. IFRS 1 also requires a reconciliation of equity under your old accounting standards to equity under IFRS, as well as a reconciliation of profit or loss for the latest period presented under the old standards. It's all about transparency and helping people see how the transition affects things.
So it's like building a bridge between your old accounting world and this new IFRS world.
That's a great way to put it. Now, let's switch gears and talk about something super important for making sure people trust financial reporting. Related party disclosures. IAS 24 provides the rules for this.
Related party disclosures, it sounds like it's all about avoiding conflicts of interest and making sure everything is on the up and up.
You're absolutely right. IAS 24 wants to prevent companies from hiding any shady dealings with related parties. These are people or organizations that can control or significantly influence the company. It makes companies disclose the nature of those relationships and any transactions they've had with those parties.
So, if the CEO of a company sells a building to the company, but at a much higher price than it's really worth, IAS 24 would say you have to tell everyone about that transaction, even if it was technically legal.
Exactly. It's all about shining a light on any transactions that could benefit those in control, even if it hurts the other shareholders or stakeholders.
It's like a safety net to protect against people abusing their power. So who are these related parties?
IAS 24 defines them pretty broadly. They include parent companies, subsidiaries, associates, joint ventures, key management personnel, and even close family members of those key people. It also includes entities that are under common control, like two companies owned by the same person.
Okay, so it's a pretty wide net. And what exactly has to be disclosed?
Companies have to disclose the transactions themselves and any balances they have with related parties, things like loans or receivables. The idea is to give a complete picture of all the dealings the company has with those who might have too much influence.
It's all about transparency and accountability. Now, our document mentions a specific set of standards for small and medium-sized entities, the IFRS for SMEs.
Right, the IFRS for SMEs. It's like a simplified version of IFRS, recognizing that the full set of standards can be really complicated and burdensome for smaller companies. It makes a lot of the recognition and measurement principles easier to understand, requires fewer disclosures, and leaves out topics that aren't relevant for those smaller companies.
So it basically makes IFRS more accessible for those smaller companies. Does it cover all the same areas as full IFRS?
It covers a pretty wide range of topics, including financial statements, inventories, property, plant and equipment, revenue, leases, and financial instruments. But it does so in a more concise and simplified way.
Like a streamlined version of IFRS. But can any company choose to use the IFRS for SMEs?
It's not that simple. It's meant for entities that don't have public accountability, meaning their debt or equity securities aren't traded on a public market. And it's also for companies that don't hold assets in a fiduciary capacity, like banks and insurance companies.
Okay, so it's really for smaller private companies that don't have the same level of reporting requirements as public companies.
Exactly. And it's important to remember that a company can't pick and choose between full IFRS and the IFRS for SMEs. It's one or the other.
It's a complete set of standards specifically designed for a certain type of company. Okay, as we wrap up our IFRS deep dive, let's talk about a few final standards that our document mentions. First up is IAS 10.
IAS 10 is all about those things that happen after the reporting period, between the balance sheet date and the date when the financial statements are finalized. It helps companies figure out which of those events need to be reflected in the financial statements and which ones just need to be mentioned in the notes.
So it's about making sure those financial statements are current and reflect everything important, even if that information comes out after the balance sheet date.
Precisely. IAS 10 distinguishes between adjusting events and non-adjusting events. Adjusting events provide information about conditions that already existed on the balance sheet date, so you have to adjust the financial statements to reflect that.
What's an example of an adjusting event?
Okay, imagine a customer goes bankrupt after the balance sheet date, but before the financial statements are published. If it's clear that the customer was already having money trouble at the balance sheet date, that would be an adjusting event, and the company would have to write off that receivable.
So it's all about making sure the financial statements show the true picture of the situation at the balance sheet date, even if you don't find out for sure until later.
Okay, so what about non-adjusting events?
Those events don't require you to change the financial statements, but you might need to disclose them in the notes if they're material. For example, if a company's factory burns down after the balance sheet date, that would be a non-adjusting event.
Okay, so it's a big event, but it doesn't change the company's financial position at the balance sheet date. Got it.
Exactly. Okay, our document also talks about IAS 8. This standard is basically the rule book for accounting policies, changes in accounting estimates, and errors.
So it's all about setting the ground rules for those judgment calls that companies need to make. Precisely. IAS 8 requires companies to be consistent when choosing and applying accounting policies. That means using the same policies for similar transactions from one period to the next, unless a standard requires a change, or if making a change would give you a more relevant and reliable presentation.
Okay, so consistency is key. But what happens when you do need to make a change in accounting policy?
Well, when that happens, IAS 8 says you have to apply that change retrospectively. That means going back and restating those prior period financial statements as if you'd been using the new policy all along. It's all about making sure you can compare things over time.
It's like going back and rewriting history to fit the new policy. But what about changes in accounting estimates? Are those treated the same way?
No, changes in accounting estimates are handled differently. These are changes you make looking forward, reflecting updated information or new developments. You account for those changes in the period when the change happens and in future periods, but not retrospectively.
Okay, so like if a company changes its estimate of how long an asset will be useful, that would affect the current and future depreciation expense, but they wouldn't go back and change the past financial statements.
Exactly. And finally, IAS 8 covers errors, those unintentional mistakes that can happen in the financial statements.
We're all human, it happens.
Yeah.
So how does IAS deal with those errors?
Well, it says that you have to correct errors retrospectively, either by restating the numbers from the prior periods when the error occurred, or if the error happened before the earliest period you're showing, you adjust the opening balances of assets, liabilities, and equity for that period. It's all about making sure things are right and being transparent about it.
So being open about any mistakes and fixing them. Okay, so we've explored a ton of ground here, covering the basics of IFRS all the way to more specific topics like impairment, revenue recognition, and leases. We even talked about things like agriculture and extractive industries. What a journey.
It's been quite a deep dive into the world of IFRS. And I think this shows just how important it is to keep learning in this field. Standards change, new interpretations come up, and the global business environment is always evolving.
Absolutely. To our listener, we encourage you to continue exploring those areas of IFRS that you're most interested in. Take a deeper look into specific standards, find real-world examples, and don't be afraid to look for more information.
Remember, IFRS is more than just a bunch of rules. It's a framework for communicating financial information in a clear, consistent, and transparent way across the globe. In a world that's increasingly connected, understanding IFRS is only becoming more important.
Well said. And on that note, we'll wrap up our IFRS deep dive. We hope you've enjoyed this journey and feel more confident navigating the world of international financial reporting. Thanks for listening.